Chapter 1. The Origins of Bitcoin. In the early 2000s, a mysterious figure going by the name of Satoshi Nakamoto began posting on online forums discussing cryptography and digital currencies. Nakamoto's writings showed a deep understanding of computer science and economics, leading many to believe that he was a team of individuals rather than a single person. In 2008, Nakamoto released a white paper entitled Bitcoin, a peer-to-peer electronic cash system, outlining a new type of digital currency that could be used for online transactions without the need for a trusted third party. Bitcoin was designed to be decentralized, meaning that it would not be controlled by any government or institution. Instead, it would be managed by a network of users who would verify transactions and add them to a public ledger known as the blockchain. Each user on the network would have a copy of the blockchain, ensuring that all transactions were transparent and secure. Nakamoto released the first version of the Bitcoin software in 2009, and the first Bitcoin transaction took place shortly thereafter. The early days of Bitcoin were marked by a small but dedicated community of developers, miners, and enthusiasts who saw the potential of the technology. Chapter 2. Mining for Gold. One of the key features of Bitcoin is its mining process, which allows users to earn new Bitcoin by contributing computing power to the network. In the early days of Bitcoin, anyone with a computer could mine for Bitcoin using the software provided by Nakamoto. However, as the network grew, so did the complexity of the mining process. As more and more people began mining for Bitcoin, the competition for new blocks increased, leading to the development of specialized mining hardware. These devices, known as ASICs, were designed specifically for Bitcoin mining and allowed users to earn more Bitcoin than traditional computer-based mining. Today, Bitcoin mining is dominated by large mining farms located in countries such as China and Kazakhstan. These farms use massive amounts of electricity to power their ASICs, leading to concerns about the environmental impact of Bitcoin mining. Chapter 3. The Silk Road. One of the early use cases for Bitcoin was as a currency for the dark web marketplace known as the Silk Road. The Silk Road was an online platform that allowed users to buy and sell illegal goods and services anonymously using Bitcoin. The platform was shut down by the FBI in 2013, and its founder, Ross Ulbricht, was sentenced to life in prison. The Silk Road had a significant impact on the perception of Bitcoin and other cryptocurrencies, with many associating them with illegal activities. However, Bitcoin continued to gain traction as a legitimate form of payment, with major companies such as Microsoft, Expedia, and Overstock.com accepting Bitcoin as payment. Chapter 4. Mt. Gox and the First Bitcoin Bubble. Mt. Gox was one of the first and largest Bitcoin exchanges, handling up to 70% of all Bitcoin transactions at its peak. However, in 2014, the exchange was hacked, and 850,000 Bitcoin, worth over $450 million at the time, were stolen. Mt. Gox filed for bankruptcy shortly thereafter, leading to a sharp decline in the price of Bitcoin. The Mt. Gox hack was a wake-up call for the cryptocurrency industry, highlighting the need for better security measures and regulation. It also marked the beginning of the first Bitcoin bubble, with the price of Bitcoin skyrocketing to over $1,000 before crashing in early 2014. Many early Bitcoin investors saw their holdings lose significant value, leading to a period of uncertainty and doubt about the future of Bitcoin. However, despite the setback, the cryptocurrency movement continued to grow, with new coins and exchanges emerging to fill the void left by Mt. Gox. Bitcoin's underlying technology, the blockchain, also began to gain attention from businesses and governments as a way to streamline transactions and improve security. Chapter 5. Altcoins and the ICO craze. Bitcoin was just the beginning of the cryptocurrency movement. In the years following Mt. Gox, a wave of new cryptocurrencies emerged, each with their own unique features and use cases. These coins, known as altcoins, included Litecoin, Ripple, and Ethereum, among others. Ethereum, in particular, was significant because it introduced the concept of smart contracts, which allowed for the creation of decentralized applications, DApps, on top of the blockchain. This opened up a world of possibilities for developers, who could now build applications that ran on a decentralized, trustless network. In 2017, the cryptocurrency industry experienced another boom, this time fueled by the initial coin offering, ICO, craze. ICOs were a way for new blockchain projects to raise funds by selling their own cryptocurrency tokens to investors. Some of these projects were legitimate and went on to become successful, while others were scams or failed to deliver on their promises. The ICO craze brought both excitement and skepticism to the cryptocurrency industry, with some seeing it as a new frontier for innovation and investment, while others viewed it as a bubble that was bound to burst. Chapter 6: The Future of Cryptocurrency. In the years since the ICO craze, the cryptocurrency industry has continued to evolve and mature. Many of the early challenges around security, regulation, and scalability have been addressed, leading to a growing acceptance of cryptocurrencies as a legitimate asset class. One of the most significant developments in recent years has been the rise of decentralized finance, DeFi. DeFi applications use blockchain technology to offer financial services such as lending, borrowing, and trading, without the need for a central authority or intermediary. Another significant trend has been the emergence of central bank digital currencies, CBDCs. CBDCs are digital versions of fiat currencies, issued and backed by central banks. While CBDCs may not be as decentralized as Bitcoin and other cryptocurrencies, they could offer significant benefits in terms of efficiency, security, and financial inclusion. As the cryptocurrency industry continues to evolve, it will face new challenges and opportunities. Some of the key areas of focus will include improving user experience and accessibility, addressing environmental concerns around Bitcoin mining, and navigating the complex regulatory landscape. Chapter 7: Bitcoin mining and environmental sustainability. As Bitcoin has grown in popularity and value, so too has the energy required to mine it. The mining process requires a massive amount of computing power, which in turn requires a significant amount of electricity. As a result, Bitcoin mining has come under scrutiny for its environmental impact. According to a study by the Cambridge Center for Alternative Finance, Bitcoin mining consumes more energy than entire countries such as Argentina and the Netherlands. Much of this energy comes from fossil fuels, leading to concerns about the carbon footprint of Bitcoin mining. While some argue that Bitcoin mining can be powered by renewable energy sources, such as hydroelectric or solar power, the reality is that the vast majority of mining still relies on non-renewable sources. The environmental impact of Bitcoin mining has led to calls for greater sustainability in the industry. Some have proposed solutions such as mining pools that use renewable energy sources, or the use of more energy-efficient mining hardware. However, others argue that the problem is not with Bitcoin itself, but with the broader energy system. They point out that the energy required to mine Bitcoin is small in comparison to the energy consumed by traditional financial institutions, and that Bitcoin mining could eventually help drive the adoption of renewable energy sources. Regardless of the debate, it's clear that sustainability is an important issue that the cryptocurrency industry must address as it continues to grow and mature. Chapter 8: NFTs and the Future of Digital Ownership. In recent years, a new type of cryptocurrency has emerged that is specifically designed for non-fungible tokens, NFTs. NFTs are unique digital assets that can represent anything from artwork to music to virtual real estate. Because NFTs are stored on the blockchain, they can be verified and authenticated in a way that traditional digital assets cannot. NFTs have already had a significant impact on the art world, with several high-profile sales of digital art fetching millions of dollars. However, the potential applications of NFTs go far beyond art, and could include everything from ticketing to gaming to identity verification. As NFTs become more widespread, they could fundamentally change the way we think about digital ownership and value. Chapter 9: The Intersection of Cryptocurrency and E-commerce. As the use of cryptocurrency continues to grow, it is increasingly being integrated into e-commerce platforms as a form of payment. Several major retailers, including Amazon, have explored the possibility of accepting Bitcoin and other cryptocurrencies as payment. In addition to providing a new way for consumers to make purchases, cryptocurrency can also offer benefits to merchants, such as lower transaction fees and increased security. As the cryptocurrency industry continues to mature, we can expect to see more e-commerce platforms embracing cryptocurrency as a legitimate form of payment, leading to greater adoption and integration of the technology into everyday life. Chapter 10: Conclusion. In conclusion, the creation of Bitcoin in 2008 marked the beginning of a new era of digital currencies and blockchain technology. Over the past decade, the cryptocurrency industry has experienced its fair share of challenges, including the Mt. Gox hack and the ICO craze, but has also made significant strides in terms of security, scalability, and regulation. As we look to the future, the industry will continue to face new challenges and opportunities, from the rise of DeFi to the emergence of CBDCs. However, it's important to remember that the success of the industry depends on a range of factors, from innovation and collaboration to sustainability and regulation. By addressing these issues in a thoughtful and proactive manner, the cryptocurrency industry has the potential to transform the way we think about money and financial services, and to create a more equitable and inclusive financial system for all. So, keep the conversation going by sharing your thoughts in the comments below, and don't forget to give this video a big thumbs up if you found it insightful. Be sure to subscribe and hit that notification bell for more crypto videos. Until next time, stay curious and stay connected.